The U.S. national debt and tariffs, what's actually happening? The United States is going through a significant economic shift right now, and it's worth taking a moment to understand what's actually driving it beyond the headlines. Let's start with the basics. The U.S. national debt currently stands at over $36 trillion. That figure has been climbing for decades across administrations of both parties. It represents the cumulative gap between what the government spends and what it collects in taxes. The debt itself isn't new, but its scale is, and so is the cost of carrying it. As interest rates have risen in recent years, the annual interest payments on that debt have grown substantially, now exceeding $1 trillion per year, making it one of the largest line items in the federal budget. This is the backdrop against which current trade and tariff policy is unfolding. So what are tariffs, and why are they being used? A tariff is essentially a tax on imported goods. When the U.S. government places a tariff on, say, steel from another country, American companies that buy that steel pay more for it. The goal is typically to make domestically produced goods more competitive in price, encourage local manufacturing, or use trade access as a bargaining chip in international negotiations. The current administration has applied tariffs broadly on goods from China, the European Union, and other trading partners. Proponents argue this could reduce the trade deficit, bring manufacturing jobs back to the U.S., and give American negotiators leverage. Critics point out that tariffs often raise prices for consumers and businesses, can disrupt supply chains, and frequently trigger retaliatory measures from other countries, which then hurt American exporters. Both of these things can be true at the same time. Tariffs are a blunt instrument, and their effects are rarely straightforward. How does this connect to the national debt? The link isn't direct, but it's real. A large and growing national debt limits the government's flexibility. When debt servicing costs consume a growing share of tax revenue, there's less room to invest in infrastructure, education, healthcare, or to respond to economic downturns. It also makes the country more sensitive to changes in interest rates, because higher rates mean higher borrowing costs on new and refinanced debt. If investors, both domestic and foreign, were to lose confidence in the U.S. government's ability to manage its debt, they might demand higher returns on U.S. Treasury bonds to compensate for the perceived risk. That would push interest rates up further, compounding the problem. This isn't an imminent scenario, but it's one that economists and policymakers take seriously. The U.S. dollar's status as the world's reserve currency has historically given the country unique borrowing advantages, but that status isn't guaranteed forever. Several countries have been gradually diversifying their reserves and exploring alternatives for trade settlements. It's a slow shift, not a sudden one, but it's worth watching. What about the stock market? Markets dislike uncertainty. When tariff announcements are made without clear timelines or outcomes, businesses struggle to plan and investor confidence can waver. This shows up as volatility, sometimes sharp drops in stock prices. It doesn't necessarily mean a crash is imminent, but it does reflect genuine concern about the economic outlook. Corporate earnings can be affected when input costs rise due to tariffs, or when export markets shrink because trading partners impose their own retaliatory measures. These are real economic pressures, not just market noise. What should you actually do with this information? First, keep perspective. The U.S. economy is large, complex, and has navigated serious challenges before. Alarm is rarely a useful investment strategy. That said, it's always sensible to review your financial situation periodically. A diversified portfolio, spread across different asset classes and geographies, is generally more resilient than one concentrated in a single type of investment. Maintaining an emergency fund gives you flexibility if economic conditions tighten, and staying informed through reliable, balanced sources helps you separate signal from noise. The national debt, trade policy, and monetary conditions are interconnected issues that will shape the economic environment for years to come. Understanding them without panic but without complacency is the most useful thing any of us can do. We'll continue following these developments closely and break them down as clearly as we can. If you found this helpful, subscribe so you don't miss future updates.